So, firstly, thank you so much, sir, for taking out the time to speak to us, even though it's really early in the morning for you. And really honored to have you with us today. So, Mr. Pabrai is extremely well-known investor and philanthropist all over the world, and he's currently the managing partner of Pabrai Investment Funds.
Thank you so much for coming. It's an absolute honor and a privilege to be moderating this session. So, my first question is on mental models. Both you as well as your longtime friend and advisor, Charlie Munger, have emphasized the importance of having several toolkits or having several mental models to prevent man with a hammer syndrome. So, how do we as young investors and students go about developing that in a way that, like, if we look at a problem, we have several ways to analyze it? That's the first part. And the second one is, what have been some of your favorite mental models?
Yeah, so I think mental models are really important. I think they give you unfair advantage in life. It's always good to have an unfair advantage. A lot of mental models will come from direct experience. So you will increase your repertoire and range of mental models over time. You can take some deliberate action to get more proficient at different mental models. And basically, if you notice that you understand something about the way the world works, that most of your peers or others around you or people in the planet don't understand that or don't appreciate how important that is, that can get you an edge, a significant edge. So you have to be an observer and you have to, pay attention to what's going on. So, for example, you could jumpstart your journey towards having a lattice work of mental models by reading Munger's essay, The 25 Causes of Human Misjudgment, which is, you can pull it up online. There's a video also, maybe a few videos online. And it's, I think, the last chapter in Poor Charlie's Almanack, which now is, I think, published in India as well. So you can get that fairly cheap. And it took Charlie probably more than 4 or 5 decades, maybe more, to gain the knowledge and perspectives to give that speech. So psychology of human judgment is really a talk that took Charlie a lifetime to accumulate and understand. Right. And so we will not get it as well as Charlie because we do not live it. We are just reading it. But if you become very intense about reading it and imbibing it, I try to reread that speech every year because every time I read it, I find stuff that I'm sure I'm reading for the first time. Like I say, I've never really thought about this. So, for example, so these mental models, they come from the fact that because evolution is a very messy process, and because our brains are a mix of ancient and modern, kind of mishmash together, there is a lot of quirks and weirdness in our brains. And having an understanding of some of those quirks and weirdness can be quite important. So, for example, in the times of hunter-gatherers, someone would go hunting and bring down a big animal. Now, when they bring down a big animal and they bring it to their community, they cannot refrigerate that animal and eat it over a long period of time because there's no refrigeration. So what the hunter does is he calls all his neighbors and says, I want to share a big feast with you. And in effect, what he's doing is he's storing that meat in the bellies of his neighbors. And he solves the refrigeration problem with that approach. And then when somebody else brings down a beast, they remember, oh, Karthik gave me a nice feast a few weeks back. Definitely, I'm going to call Karthik for my feast this time. So reciprocation as a trait in humans probably got hard-coded in us around that time because the people who reciprocated generally did well in life. Their genes got passed on, etc. So reciprocation became etched. But there's a quirk in the way the reciprocation gene exists in most of us. I can remember that Karthik did a favor for me, but I cannot calibrate how large or small that favor was. All that my brain can process is a favorable opinion of Karthik. And because of this calibration piece missing, I actually have used this for several decades and I continue to use it even today. So for example, if someone asks for information on Pabrai Funds, they want to invest or they're thinking of investing, etc., most of my competitors or other funds will, send them stuff online and different things and say, Here's all the documents, here's the information, whatever else, and we can talk, etc. And we do that. What we also do is we send them a physical package. And the physical package has some freebies in it. It has a book, it has a very nice cross pen, and it has the same documents and everything in hard copy as well, which they don't need, but it's there. Now, when people receive that cross pen or the book, what happens is that implicitly they have now gotten, they are obliged to me. They received something from me, and in their brains, they think they have to give something back. Favorable opinion of Mohnish. But the way it works is that I send you a $30 cross pen, you send me $10 million because they can't calibrate, because it's not there in the brain. So how many $30 pens can I send out before I lose my shirt? Like an infinite number, not even a rounding error, right? And now what happens is 1 or 2 out of 100 packages we send out, people send the entire package back. I looked at it, I'm not interested, I'm returning your, because those people are trying to avoid having the obligation. Now, the problem is that to return the package is complicated. You have to like put postage and take it to a post office or UPS or FedEx or something. There's a frictional cost of time and effort involved in doing that. So most people who even want to send it back are unable to do so. And if you don't send the package back, you have a favorable opinion of Mohnish. And what ends up happening with the favorable opinion of Mohnish is the Ashoka students want to talk to Mohnish because somehow they think I'm a great person to talk to. That's one model, right? The reciprocation tendency and the quirk in how reciprocation works. Like this, there are hundreds of models. And what Munger said is that when multiple models work in the same direction, that's when you get Lollapalooza effects, where 1 + 1 becomes 11. आपको स्कूल में गलत बताया है कि 1 + 1 = 2. Our focus is that 1 + 1 should equal 11. So there's another mental model which has been very important to me. And I still don't understand exactly why humans are this way. But humans have an aversion to cloning. Somehow they think that cloning or copying is beneath them. हमको स्कूल में सिखाया जाता है कि copying बहुत बुरी चीज है. Actually, copying बहुत अच्छी चीज है. So now most humans feel that when they create a company or create an organization or start some endeavor, they have to do something new. Because how can you make things work if you just copy what someone else is already doing? So they look at something being done and said, oh, that's a good idea, but I cannot do that because somebody is already doing it. The reality is that in the world, there is room for multiple participants to provide the same product or service. And so just because someone else is doing it doesn't mean that the opportunity is gone. In fact, if you are an intense cloner, you will do extremely well. So the richest family in America is the Walton family, the descendants of Sam Walton, who founded Walmart. Now, there's no single Walton who's the richest guy, but if you pooled all the Walton family wealth together, they would be the richest. It has been 55 years since the IPO of Walmart. And after 55 years of IPO, and it has been 33 years since Sam Walton died, the Walton family collectively own 46% of Walmart today. Now, Sam Walton was the ultimate cloner. Every single thing that Walmart did, at least for the first 20 years, maybe more, there was no original idea Sam Walton had. He copied Sears, he copied Kmart, he copied a zillion merchants, and anytime his family would go on vacation, like they'd be driving, taking some road trip somewhere, and they're passing some retail store, Sam would tell the family, stay in the car, I'll be back in a few minutes. He would run into the store and he'd want to see what they were doing and what he could copy from them. And Sam Walton said that there is no human alive who has stepped inside more retail stores which are not named Walmart than me. He always was going into competitor stores. And even when the competitors were useless, he was looking say कि इस useless आदमी से क्या एक दो चीजें हैं जो मैं सीख सकता हूँ. Even from useless operators, he was trying to learn. And the end result is that Walmart is basically an amalgamation of copied ideas from a bunch of different places and intensely pursuing those ideas and doing well. If you look at Microsoft, Windows is copied from Apple. Word is copied from WordPerfect. Excel is copied from Lotus. Bing is copied from Google. And my friend Warren Buffett says, he tells me, Mohnish, do you know what Bing stands for? Bing stands for, but it's not Google. So everything that has worked for Microsoft, including now AI, has been copied from other places. And Microsoft spends billions of dollars every year on research. Nothing has come out of it. So their internal research labs with all these PhDs and, top 100 rank IITians and all of that, nothing has been produced by them that we can look at and say, oh, this is great. Everything that has worked for them, which has created most of the wealth, has been topoed from someone else. So that's another mental model. So now, when you read The Psychology of Human Misjudgment and you really understand it, in fact, you need to read it several times, that'll get you going. But the other thing you can do is you need to be a curious person and you need to read and imbibe a lot of things from a lot of areas. But you also need at the same time to go deep into an area that you have a deep interest in. Don't go into an area which is popular. जैसे अभी AI popular है ना. In fact, my advice to you would be ignore what is popular. What is more important is try to understand who you are. Understanding who you are is very complicated. But if you can understand who you are, if you can understand what your strengths are, if you can understand what your passions are, and if you can go all in on those, that is excellent. And I'm sorry to tell you this, but school is not a good place to figure all this out. Because स्कूल में क्या होता है कि आपको कुछ पढ़ाया जाता है, उसी सिलेबस में से टेस्ट आता है. टेस्ट में nothing comes outside the syllabus. You guys will protest, this is outside syllabus, sir. And the real life is that you encounter issues and problems where there is no syllabus. In fact, most things in real life you have to figure out. And many problems nobody has figured out. So basically, that's the skill you need to hone in. What school does, unfortunately, now Ashoka does a better job than others, but what school does, unfortunately, is they make you into really good test takers. Test में कैसे अच्छे number लाने हैं, grade लाना है. This is what school teaches you. That has no relevance in the real world. So sorry to break it to you. Now, एक क्वेश्चन 20-20 मिनट लेंगे तो 3 क्वेश्चन में सेशन खत्म हो जाएगा. But this is the way I am. So let's try your next question.
Thank you for the answer. So you mentioned cloning as a mental model for you. So when you look at, say, Buffett or Munger holding a stock, a top stock, and then how do you get through the bias of them owning that stock and develop your own thesis of, say, either buying or selling, or no thesis at all? How do you get over that bias of them owning it?
One of the important questions to ask. I play bridge. I like playing duplicate bridge. I would recommend you guys take up bridge, especially duplicate bridge. And recently I started playing duplicate bridge with a former world champion. This guy became world champion at 23. And he's now 38 or something. Anyway, he was telling me that most important thing when you're playing bridge and you're playing a hand is ask yourself the question, what is going on here? If you see some strange card come out that makes you do a double take, ask yourself the question, what is going on here? Now, when this guy plays bridge, it's like the opponents have exposed all their cards to him. Whenever I play bridge with him, it's like he already knows what people are holding, even though they're holding the cards in their hand. In his head, he already knows every card where it is. It's just amazing, incredible to watch, actually. So the Buffett Partnerships, which was what Buffett originally started with, were run from 1956 to 1969, 13 years. And the Buffett Partnerships had unusual rules. One of the rules that Buffett had was he didn't charge a management fee. All mutual funds charge management fees and hedge funds charge 1 and 20 or 2 and 20 or whatever. His fee structure was 0, 6, 25. 0 management fee, 6% hurdle, And above the hurdle, he got 1/4 and investor got 3/4. Now, when I heard about Warren Buffett for the first time in 94, 95, it had been more than 25 years since he closed the partnership, shut it down. And when I looked, I could not find a single case of anyone who had set up a partnership or an investment fund following Buffett's rules of no management fee, zero. So now what that told me is wide open opportunity, right? So there are multiple mental models coming in here. The first is what my bridge partner Roger says. What is going on here? So, well, what is going on here is we already know humans are idiots about cloning. Unke samne pada hua hai model of the greatest investor ever, the greatest returns. Nobody wants to touch it. Well, the Indian guy is going to go touch it and take it because it's just sitting there. I saw that that model was not cloned. I know that humans are bad at cloning. That is why Walton did well, and that is why Bill Gates did so well, because people are not willing to stoop so low as to create a company like Walmart or Microsoft. They think that's beneath them. These are low quality businesses and low quality operations because they have done copying. So no one is interested in these companies. So I said, model is there. Nobody wants it. I can go do it. And when I took that model, now when I go to potential investors, I have a unique proposition. I tell my potential investors, everybody else is going to take a fee from you. They will get rich when you get poor. No matter what happens, they'll get rich. In my case, I only get rich when you get rich. We are aligned. So it became unique. And so the model of, I took a little detour from your question because I wanted you to understand this notion of offering gaps. Someone had come up with a model, 25 years had passed. In fact, it was 30 years by the time I started the model. Now, later, when I became friends with Warren and Charlie, I told Charlie this. I said, Charlie, this is what was going on. He said, Mohnish, there were a few people who had copied that model. I said, yes, but Charlie, I could never find them. He said, yeah, you would never be able to find them. These are very obscure people. So again, it was like 99+% of humans had not done that.
How do you overcome the bias of, say, legendary investor buying a stock? How do you overcome that bias by looking at it yourself?
First of all, if you limit yourself to stocks that are largest or second largest or third largest position of maybe 20 investors that you admire. So let's say you made a list of 20 great investors. And let's say you look at their top 2 or 3 holdings. So you're now looking at like 40 to 60 stocks. So there are 50,000 stocks in the world. So we would have already cut out 99.9% of stocks by doing that, which is beautiful. Cloning helps you trim the data set properly. Now, the second question you have to ask when you look at those 50 or 60 stocks, most important question, is this stock in my circle of competence? And most of the time, the correct answer is no, because most of us are only going to understand a few things, right? So out of those 50, 60 stocks, maybe 45 will disappear because they're outside circle of competence. So now we are left with 5 or 10 stocks. And then those are within our circle of competence. And we can go into a deep dive. And the deep dive is focused on first answering the first question. Why did Mr. XYZ buy this stock and make it one of his largest positions? Why did he do that? Why did he or she do that? And then we go down from there.
So my next question revolves around the fact that in several podcasts as well as interviews, you mentioned the importance of buying a good quality, well-run company and holding it through thick and thin. Everything surrounding the company, which is mainly noise, to ignore that. But given the current scenario, especially with the Trump tariffs, how do you differentiate between something that is actual noise versus something that is substantial and might potentially change the world order?
Trump tariffs are mostly irrelevant. And the reason they are irrelevant is, let's take the example of a great business in India called D-Mart. Raise your hand if you are familiar with D-Mart. And raise your hand if you have been inside a D-Mart. All right, very good. So what impact do Trump's tariffs have on D-Mart? Do we think D-Mart has become a useless business now because of Trump tariffs? Kya relevance hai? Abhi, let's take a business like Indigo. what impact does the Trump tariffs have on Indigo? So when we look at D-Mart, and clearly the Trump tariffs will have some negative impacts if global GDP growth slows down. But we don't actually know exactly how those things may play out. So one of the things about the whole tariff situation is that in a free and fair trade scenario, overall the world is better off. Now, Trump's pet peeve is that trade is not fair. And if you look at it in the context with India, I completely agree with Trump in the sense that a lot of American goods coming into India attract very high duties coming in. A car made abroad coming to India, very high duties, and so on. And so it's not free and fair trade. So if the end result is that India reduces its barriers to foreign goods coming in, I think in general that'll be good for India. Because what would happen is that it would force on the margin, it would force domestic producers to sharpen their pencil and get better. And it also would force resources within India going into areas where India has an edge. So India has an edge in shrimp farming. In Andhra, the rice farmers have become shrimp farmers. There was no government program. The government didn't even know this was happening. India has become the number one shrimp exporter in the world. It used to be Thailand. And out of nowhere, in a very short period of time, India has become dominant in shrimp farming. The reason it became dominant is because various factors of production, when you put them all together, India has a competitive advantage. It has a competitive advantage in pharma manufacturing. It has a competitive advantage in outsourced IT services. So what India needs to focus on is the places where it has a serious competitive advantage and remove the shackles which restrict growth. There are gazillion shackles in India which restrict growth. For example, farms are not allowed to become large. The buying and selling of agricultural land is very restricted because there is inherent distrust. But in the US, all we have are large farms. It used to be in the US that 95% of the population was focused on farming. Now, less than 2% is focused on farming, and we are producing so much that we need to export it in the US. In India, still a majority of the country is focused on farming. We only need 5 or 10 million people focused on farming. Let the farms become efficient. Remove the shackles. Let's go. So anyway, when we have headlines like Trump tariffs, this and that, all that is not really relevant. What you have to do is you have to look at a particular business and you have to play that tariff out in the context of that business. And what you'll usually find is internal micro factors or factors around that business with its competitors have most of the impact of how that business does in the future, not some global macro thing. So tariffs are like whatever.
So while starting out, we've been restricted to researching Indian businesses and restricted to the Indian market. So you have a very global perspective of how you invest, and what are the benefits of having a global perspective, and what is the biggest challenge you face while looking at multiple geographies or investing?
One doesn't necessarily gain an advantage by having a large canvas to draw on. I've mentioned a few times in previous talks, there was a very good friend of Charlie Munger, John Arrillaga. John Arrillaga was a real estate investor. He was a billionaire. And in fact, his daughter is married to Mark Andreessen. So that's billionaire to the power of billionaire, So anyway, John Arrillaga, in his entire life, only invested in real estate within 2 miles of the Stanford University campus. That's all he did, nothing else. And he became a billionaire. So what is John Arrillaga's circle of competence? Well, it's this small, it's really tiny. One can get extremely wealthy by having a very tiny circle of competence. One of my mental models, which I actually came to realize, it's a very simple model. I came to realize this during the financial crisis, is that if you are a commodity producer, and now when I'm going to describe it to you, you're going to say this guy's a total idiot. But if you're a commodity producer, producing, let's say, iron ore or coal or oil or whatever, and you are at the low end of the global cost curve, and you have a lot of reserves. That is a business that with a very wide and deep moat. All they're doing is, basically mining some commodity. So if we look at a business like, let's say, Saudi Aramco, right? I mean, it used to be that Saudi Aramco used to produce oil at $1 or $2 a barrel. That was their cost. And I don't know what their cost is right now, but I would be shocked if it's more than $10 a barrel. Maybe it's like $5 or $7 a barrel, most of the oil they produce. Now, everybody else would stop producing oil if oil went to $20 a barrel. But Saudi Aramco would still be producing and still be making money. That is a very durable moat, right? So it's a very simple model, which is that if there is a commodity producer and they're sitting on the low end of the cost curve and they have a lot of reserves, that's a license to print money. You're going to make money no matter what. And there's a company in my portfolio which produces metallurgical coal, which is used to produce iron and steel. They have extremely low costs. They're very close to the port. They can send their products globally. They have very long-lasting reserves. They have no debt. Where do I sign? Right? So that becomes very simple. Trump tariffs, whatever, who cares? So what we want to do is that when something hits us over the head with a 2x4, now the 2x4 is an American term. It's not the metric system, 2 inches by 4 inches. It's a log of wood commonly used for construction of US houses. If something hits you in the head with like a cricket bat, let's say that instead of 2x4, that's what we want. We want things that are like total no-brainers. Like, what's going on here? Take it from there. So we don't need large circle of competence. John Arrillaga proves that to us. We can have a very tiny circle of competence. And we don't need to know a lot of things about the way the world works. We need to know a lot about a few things. So it's better to be an inch wide and a mile deep than to be a mile wide and an inch deep. So if you really understand very few businesses or very few industries, but you understand them extremely well, and then you invest in them in periods where it appears you can't lose, then that's over time may work.
So, Mohnish, sir, my next question is the fact that Pabrai Investment Funds has no analyst, no hired analyst apart from you. What is the rationale behind that and doing it all by yourself?
Well, I do have a couple of guys now who are very helpful to me, but that was because I had started a business that didn't work and we got out of the business, but I liked the guys. And so I wanted to keep them. And I told them, I don't want them to generate ideas. They don't generate ideas, but they've been very helpful to me in terms of the deep dives, when I have specific things I want to kind of go deeper into or whatever. So it's been helpful. But if that accident had not happened, I wouldn't have had anyone. The reason is that in a year, I'm buying 1 or 2 things and maybe I'm selling 1 or 2 things. And if the job is done right, which I don't think I do the job right, but if the job is done right, then one would never sell. So anytime there's a sale of anything, it means I've made a mistake. And when I look back, that means I've made a lot of mistakes. So the bottom line is that we don't need to own a lot of things. We don't need to find a lot of things. What we are looking for is we're looking for no-brainer anomalies. Like when things don't make sense. Like I like to invest when things make no sense. And when things make no sense, that's when I get kind of excited to kind of look into what's going on. Like, for example, 7 years ago, I started visiting Turkey. And when I went the first time in 2018, I had no big agenda. I was only going to basically visit Istanbul once. And the reason I was making that visit is I had a very good friend in Istanbul who's a very good value investor. In fact, problem is he's too much Graham and too little Munger. But anyway, I told him, Turkey was screening extremely cheap. Everyone was exiting. And I said, I'd like to visit companies in his portfolio, starting with the ones that were the largest positions and then going down the list. And I didn't want to visit any companies that he didn't have money in. And if he was okay with doing that, and he was very excited to do it. He said, yeah, it'll be great. Let's hang out. So when I visited Turkey the first time, I remember the first company he took me to was a PE of 0.1. It was trading at 1 month's earnings. And I won't go into the details of that business because that'll use up the rest of your time without getting to the point. But I found Turkey incredibly cheap. I found that everyone was exiting. And so then I said, okay, let's look at the businesses that are immune to whatever, currency and inflation and things are going on. And the second year I visited, and usually what I was doing is when I was visiting Turkey, I did no work on the businesses we were going to visit until after we visited them because I didn't want to waste my time. I said, okay, I'm going to see how the meeting goes, see if there's anything that interests me about the business. And then after that, if there's interest, I'll dive in. So usually when we were driving to a business, I would ask my friend some few questions, what business are they in? What industry they're in? What's going on? Why did you invest, etc. Just a few questions. So I'm actually not a complete village idiot at the meeting. And so the second visit in 2019, he was taking me to his company. He said, Mohnish, the market cap is $16 million, 1.6. Liquidation value is 800 million. And I said, is it a fraud? Like it's trading at 2% of liquidation value. He said, no, I have money in the business. It's in my portfolio. I said, why is it so cheap? He said, well, everything in Turkey is cheap. So when I visited the company, it seemed like a pretty normal company, very basic, boring business. They rent warehouses to large Fortune 500 companies, Amazon, IKEA, Carrefour, Mercedes, Toyota, all these are like clients of theirs, DuPont and so on. 99% lease, inflation index or dollar leases or euro leases. And you could have gone to any realtor in Istanbul, showed them the portfolio and they would have told you in about half an hour, this is worth $1 billion. And there was 200 million of debt. So he was right. It was worth 800 million and the liquidation value was 16 million. The market value was 16 million. Then I thought there wouldn't be any volume to buy the stock, whatever. But Turkey is a country of gamblers. So the average float of a Turkish company cycles through in about 21 days. Very high trading volume. So the float is just continuously cycling through. The typical retail Turkish investor invests at 10 o'clock and wants to exit at 3 o'clock and make 10%. That's their model. Invest at 10 o'clock, sell at 3 o'clock and make 10%. Where do I sign? So Buffett has a quote that the stock market is a mechanism to transfer wealth from the active to the inactive. And it couldn't be truer in Turkey. So when we started buying the stock, there's huge volumes. And for, I think, $8 million, we got 1/3 of the company. And now 6 years after that, the market cap is about $1 billion. The Turkish lira is decimated. So in Turkish lira, our returns are infinite. But in dollars, it's gone from 16 million to $1 billion. But now the liquidation value of the business is over 2 billion, maybe close to 3 billion. So, the thing is that I go to Istanbul once a year. I meet the founders. We have fish on the Bosphorus. Blue fish on the Bosphorus is wonderful. And basically, I tell them that the business is our family business, their family and my family. It's not a portfolio position. And that I'm not selling that business or whatever until they do something. If they sell, then I would sell or whatever. So what I discovered after making the investment is that I bought this business at a huge discount to what it was worth, but I didn't realize at the time that it had gifted capital allocators. I've seen them 6 years. I've not seen them make any single mistake. All their reinvested capital is invested at 20 to 35% or more dollar returns annualized. So this company is going to keep compounding for a while. And my main job is to talk to students at Ashoka and do nothing. Just sit there and do nothing. And play bridge and so on. So we don't need too many insights. We don't need to understand too many things. What we do need is look for things that make no sense. Look for anomalies. Look for weird things. Try to answer the question, what is going on here? And then take it from there.
So you wrote the Dhando Investor like 20 years ago. If you had to rewrite it today, so which are the concepts maybe you would remove or completely rewrite, maybe based on the mistakes that you have made or what you have learned since from the other investors? Also, have you really moved away from the cigar butt approach, like from the pioneer distilleries to more compounding bets like Micron or D-Mart, as you talk about?
Yeah, that's a great question. Yeah, so I had really flawed models in terms of how I was investing earlier. So many mistakes because of those flaws. So if I could go back, one of the big tweaks I made, it's so easy to understand this and just shows you how dumb I am, is that basically if you find yourself in the fortunate situation of partial ownership of a great business with great management, what I used to do is I used to try to calculate the intrinsic value of that business. And when it got to about 90% of the intrinsic value, I would sell that business to buy something that was at half off. And that is really stupid. And it's really stupid for a few reasons. The first thing is we don't know what intrinsic value is. We may have some idea, but we're probably going to be wrong about it. Secondly, these great businesses with great managements are very rare. They're anomalies. And so if you find yourself in the happy situation of partial ownership of such a business, I mean, I'll give you an example, like, for example, when I first started investing in equity market for the first time in 95, I had $1 million to put into the equity markets, my own money. And I was going to see how I do with that. I had no prior experience investing in stocks, etc. This was 30 years ago, 1995. And out of that 1 million, I put 20,000 of that into Indian stocks. I made 4 bets in India. They were Satyam Computers, there was Blue Dart, Skypack. I was only going to make these 3 bets, Satyam, Blue Dart, and Skypack. And then while I was going through the process, I was interacting with Kotak because Kotak was my broker. And at that time, they didn't have their banking license. And I was interacting with Falguni Nair. Some of you might have heard of Falguni. And she was running Kotak's London office at that time. So Falguni helped me open my account and all of that. And I was extremely impressed with the Kotak team, both in London and in Mumbai. So last minute, I decided to put some of that money into Kotak. So basically out of the 20,000, 10,000 went into Satyam and maybe 2,000 or 3,000 went into Kotak. And then the rest was between Blue Dart and Skypack. Now, the Satyam fraud happened much later. That was more than 10 years after I invested. But in 5 years after that, in the year 2000, Satyam was up 140x. So the 10,000 I had invested in Satyam was sitting at 1.4 million. Okay. And the 980,000 that I'd invested outside of India in the US was sitting at about 13 million. So just the Satyam bet and these other had taken $1 million to like 14 million or something. And I said, okay, Mohnish, well done. Life is good. Okay. And then inexplicably, for no really good reason, in 2000, I realized we are sitting on a mega bubble and like Satyam is ridiculously overpriced, etc. And in January of 2000, I told Kotak, unload. And I got out of Satyam within 5% of the peak price, cashed in the whole thing. I wasn't even sure the Indian government would allow me to pull the money back. I said, these guys are not stupid. I put 10,000 into India. I want to pull 1.4 million of foreign exchange out. Someone's going to protest somewhere. But no, they just wired the money. It was very, very smooth. And then at that point, I said, well, God is not so benevolent. He likes Mohnish. He loves Mohnish, but he doesn't like Mohnish infinitely. So these other stocks, Kotak, Blue Dart, and Skypack had done nothing at that point. They were sitting approximately where they were, like maybe 10, 20% up. So I wanted to clean up my books. I sold those 3 stocks. Well, Kotak is like 350x after that. Okay, 350x. Blue Dart, I think, is 500x. Okay, Skypack went nowhere. No, maybe I've been a fraud or whatever. I have no idea. But basically, there was no good reason to sell Blue Dart or Skypack or Kotak. There was no reason. And they were so small, that didn't matter. So when I go through and look at the last 30 years, there are so many exceptional businesses I invested in and sold. Well, in the case of Kotak and Blue Dart, it was sold for stupid reasons. But in other cases, it was sold because I thought they were fully priced. Well, you cannot come up with an intrinsic value for Kotak or Blue Dart or any of these businesses because what will management do in the future? We don't know what they'll do. And if they're exceptional, they can do exceptional things. And so the idea is that what took me a long time to learn, forever and ever to learn, is that do not sell a great business when it's fully priced. Do not even sell it when it's overpriced. Basically, just sit on it until it just becomes completely egregious. Like you cannot possibly come up with any scenario where that valuation makes sense. But the good news is I got that message etched in my brain well before I'm going to die. Hopefully there's a 29 years and few months of compounding left. And so we can apply those lessons. Life is good. Let's take the last question.
Hello, sir. Thank you so much for the session. Wanted to understand, how do you distinguish between businesses that are distressed and businesses that are value traps? And how do you gauge whether these businesses are going to come back in favor? And just a small follow-up to that, do you time these investments for themes that are out of favor? And how do you go about timing that accurately?
Yeah, that's a great question. So in the late 60s and early 70s, there was a concept in the US known as Nifty-Fifty, which is very different and nothing to do with the Nifty-Fifty in India. Forget the Nifty-Fifty in India. In the late 60s in the US, the idea was you put 2% into 50 stocks, that'll be your portfolio. And the 50 stocks were the bluest of the blue chips. ADP, McDonald's, Coke, Procter & Gamble, and, Xerox, Polaroid, Kodak, all of them. So there were these 50 stocks, Avon, and so on. And basically the idea was you set it and forget it. You don't worry about valuation, don't worry about anything. Now there's some controversy whether Walmart was part of that Nifty-Fifty or not. But let's say for our discussion, let's say it was part of that Nifty-Fifty. So what happened is in 73, 74, there was a major downturn in the US market. It was a crash in slow motion. But like 60, 70% of equity markets value got wiped out. And these Nifty-Fifty, they were taken out back and short, like decimated. That portfolio got decimated. And after 1974, no one ever talked about the Nifty-Fifty. But let's take a scenario where you own the Nifty-Fifty, you put 2% into Walmart, and the remaining 98% goes to zero. And you forward this whole portfolio for 55 years, from 1970 to now. Well, what happens is that with 98% error rate, the Nifty-Fifty compounds at almost 15% a year for 55 years and blows out the S&P, which does a respectable 10%. Okay, and that's with 98% going to zero. I took like Amex to zero, Coke to zero, Procter & Gamble to zero. I took all these companies to zero, right? Now, a bunch of companies in the Nifty-Fifty actually went to zero, like, Xerox and Kodak and Polaroid and all that. But if you took them all out. So the reality with this business is that anytime you enter the investing business, you are going to make a lot of mistakes. Value traps, frauds, whatever, all part of the landscape. No matter how good you are, you're not going to be able to avoid them. Even the best investor, John Templeton said, will be wrong 1 out of 3 times. More than likely, you're going to be wrong maybe even 1.5 or 2 out of 3 times. Warren Buffett, out of maybe 400 plus decisions that he's made in the last 60 years, only 12 have moved the needle for Berkshire, like a 3 or 4% hit rate. And that's God we are talking about. So the important thing is not the avoidance of the value traps. You can try and do that, and you may or may not be able to completely do it, but you can try. The important thing is recognize and hang on to your winners, and the traps won't matter. Well, thank you so much. It was such a pleasure spending time with you guys.
Thank you so much, Mohnish. It was an absolutely wonderful session. And we hope that the next time we interact and have a session, it's in person. And not just you, but Mr. Spear as well. He was also quite enthusiastic about interacting with the club. So we really hope that we have you guys in person at Ashoka.
I look forward to that. That'll be wonderful. Thank you.